Welcome to the podcast. Now, despite some shenanigans that we've just encountered, I promise this will be an amazing podcast episode. So please welcome me. I have Jonathan Blau, and he is the founder and CEO of Fusion Family Wealth, a Long Island-based, fee-only, registered investment advisory firm that oversees approximately $1.1 billion in assets under advisement and management. And for more than 2 decades, Jonathan has been a trusted advisor to the trusted advisors with deep experience working with accounting and law firms on a wide array of financial service capabilities. His approach focuses predominantly on conditioning investors to learn to ignore current events. Keep that in mind. Always act on your plan and never react to the markets and media.
Welcome to your Profitable Law Firm podcast. I'm Kelley Brubaker, your dedicated host, passionate about empowering law firm owners. Let's dive into the hidden strategies that lead to overflowing profits, scaled growth, and thriving lives. This is where overwhelm transforms into confidence, enabling you to create and enjoy your dream firm and your dream life.
So, Jonathan, welcome to the podcast.
Thank you, Kelley. Pleasure to be here. One little correction that we sent you the bio is probably just not updated, but and it's not really that material, but just to be factually correct for me, we're overseeing $1.5 billion now under management.
Good for
versus
you.
$1.1 billion.
That's awesome. I love that. I mean, it's a lot of money, but it's a lot of responsibility.
And the
And
last number was before you gave us the responsibility to manage your portfolio.
don't tell people. Isn't that the secret of being high net worth? Is you don't tell people you're high net worth?
It's true. Gotta keep it secret.
It is. It'll just be between you and me.
And we actually work with a lot of professionals, a lot of accountants from major firms became our clients because that's my background. So we have to keep everything confidential or they wouldn't be comfortable working with us.
Absolutely.
Because the competitors work with us too.
Right. Yeah. I came from an auditing background. I started in Big Four. I was at KPMG. And over the years, my line of business was financial services. And so I audited a couple of different, I had one that was a broker dealer that I did a couple of broker dealers that we audited, and like, it blew my mind to have to close the books every day and all the stuff. Like, I just couldn't, it was in a whole world I just could not be involved in.
No, I remember I worked for Arthur Anderson for 4 years. So I know the dream.
We were probably in Big Four at the same time.
Yeah. Yeah.
Because I think I went in, it was Big Six. It was Big Six when
I went in. Yeah, exactly. Yeah. Now they call it the Final Four.
Well, exactly. Well, because they're all stars. But, I think when I interviewed, it was Big Eight. And then by the time I graduated and started, it was Big Six. And then by the time I left, it was Big Four. But so crazy. So I know I can share stories of me, but I like your approach to this. I mean, the intro said a lot, and I've been a sucker. I mean, I can share. So years ago, like my last job, I've had my accounting firm for 20 years. So my last job, like more than 20 years ago, I was dating a guy and he calls me at work, which never happened, and says, "Oh my God, do you have 5 minutes?" I'm like, "I don't know. Like, is the world ending? I'm not sure what's going on right now." And he goes, "I'm going to fax something over to you. You have to read it." And I'm like, "Oh my gosh, I never get faxes." I mean, this was a long time ago. Right. And so I run over to the fax machine. It comes through. Well, it's this sheet. It could be like a thing out of Wolf of Wall Street, right? It was this penny stock that had just gone IPO. And it was going to be this gold mine. And in fact, I even think the name of it was like Gold Mine something. It was in beauty. But you read this whole press release and it was, you have to get on the ground floor. I mean, it wrote as if you were getting in on day one of like Bitcoin, right?
Right. Or Amazon.
So world stops. I'm like, oh my gosh. Okay. I'm in. And so I think I put like $100 into it and went nowhere but zero. But I got caught up in the emotion of it. And I know how easy that can be. And I admit, I've dabbled in the stock market. Now, I could not do any stock trading when I was an auditor at
Right,
KPMG
because you had
because
to
that was part of the
disclose
independence
companies and
rule.
all that kind of stuff.
Absolutely. But the first thing when I quit, I'm like, "Oh, what can I buy? Got to open an account." I had like an E-Trade. Like, what can I do here? It's going to be dangerous. And, I did everything wrong. I mean,
By the way,
emotion.
yeah, when people say that, all that's different about them than the people who don't tell me that
Mhm.
is they're honest. Because human nature is a failed investor. Every human being has made some or many of the mistakes that I talk about when I talk about what we do. So the only difference between you and the other don't tell us they made mistakes is you're honest.
Sometimes to a fault.
Right. Well, no, but that's June.
Yeah. So you talk a lot about behavior being important and it's more important than knowledge when it comes to investing. Can we talk about how that and that looks like in real life?
Yeah. So in real life, so for example, you could have during the 2008 financial crisis, right, the worst market experience in modern history, anyway. And the market went from peak to trough down 60%.
Yeah.
And so what ends up happening is people just repeat the way you asked me the question. I want to make sure I answer it directly with this example.
You talk a lot about behavior being more important than
Then
knowledge when it
knowledge,
comes
right?
to
So what I always
investing.
say is what we do accounts for our success or failure about 99%. What we know, intellect, about 1%. And so that's how
Yeah.
I frame that. So in that crisis, down 60%, if we're being honest, and we have a room full of, let's say, 10 investors,
Yeah.
after the fact, now it's 2009, 2 years later, or a year and a half later. So we say in the room, 10 people. One is one or two inherited money, never really had any experience with business. 3 of them were successful entrepreneurs in different industries, very overconfident in their skills and their knowledge. And then the rest were a mixture of executives and people who maybe lost a spouse and never dealt with money before. And so the question is, are any of those people I just described more or less likely than the others to sell some or all of their stock portfolio in panic during the crisis?
Yeah.
Conversely, is any one of those 10 people more or less likely than the others to sell every piece of a beautifully diversified investment portfolio with all the important components to chase every .com in 2000? Is
Oh, yeah.
anyone less likely? So the answer is, of course, no one's less likely. So
Yeah.
no matter whether they have a PhD in finance or they never went to school, human nature is immutability. So what causes us to react changes. The stimuli changes. But the reactions, our response to fear, greed, envy, regret, that never changes. And so it doesn't matter how smart you are, and it doesn't matter how well educated or how successful in business. In fact, the more successful people are and the more well educated, the worse an investor they are behaviorally because of something called overconfidence bias. So they have
Okay.
all the built-in biases that cause human nature to fail, which I'll get into as an investor.
Yeah.
Their overconfidence acts like a giant magnifying glass over those same biases. So they do the same mistakes as everyone else with a lot more confidence and sometimes a lot more money. Two major differences.
Right.
Right. So that's what I mean. So what they knew didn't matter. It's what we do. And
Okay.
generally no one or very few people on their own can stay rational about financial decisions under the uncertainty of tariffs, pandemics,
Yeah.
Biden's, Trump's, you name it.
Right.
They can't do it on their own. And so what we do is we condition them on how to suppress the biases that will take over and learn to live with them so that they can stay rational under uncertain conditions.
And I like that because I know I have seen it. I have seen it in family, friends, clients come into money for for whatever reason. And there's just an inclination that no matter how large or small it is, if it's not normal, like if it's just a not normal amount for them, it's bigger than what they normally deal with.
Yeah.
It's just so emotional.
It's
And
all
so,
emotional. Yeah, it's all emotional. And you have to
Um,
remember, like, this is also related to the question we just answered, which is what motivates us, right?
mhm.
I'll talk about from the standpoint of an investor,
Okay.
but it motivates us generally the same way, whether we're talking about investing or any other endeavor in life, is that it's proven that we feel the pain of a loss, financial or otherwise, 2 times more than we feel the pleasure of an equivalent gain to be pleasurable.
I can believe that.
So what's natural is, as an investor, what I should be seeking out is endeavors that increase the probability that my long-term wealth and ability to retire and stay comfortably retired and leave a legacy will be the highest it can be. But that's not the kinds of things I seek out. What I seek out are investments that will minimize the chance of short-term loss. Those are the exact opposite of the investments I need to build my long-term wealth. And so we start off with that. And that's what I mean by human nature is immutable. That it's called loss aversion bias. The fact that we
Okay.
feel the pain of the loss 2 times more than the pleasure gain. That loss aversion bias exists in the person with 3 PhDs in finance or no education. And that's what I was demonstrating earlier. Okay. So
Yeah.
they can deny that they have a problem, but it shows up. It just doesn't
Right.
show up because they don't admit it. But it shows up. If you're able to look at their history, it shows up.
Right. So somebody comes to you and they're like, "Oh, I'm rational about money." Whether you believe them or not, what's early signs that you see in somebody who thinks they're a rational investor, even if
Well,
they don't believe
so
it themselves?
So, what we do in an initial meeting with someone, everything we do as a firm, yes, there are other firms that do what we do, but not a lot. But when I talk about the broad industry, the money management industry, the Morgan Stanleys, the Goldman Sachs, right? What we do is generally not just different in the approach we take. It's also often opposed to what they advise. So,
Okay.
for example, if a client comes in and says that to me, we start, okay, that's great. You may not even need our help, but let's explore that. Let's take a
Okay.
look. So in my discovery meeting, what most of the big firms I talked about doing a discovery meeting, they want to discover the client's assets. Show me what you have and how you're invested. I
Yeah.
could care less about that in the initial meeting. That's not important
Okay.
because I've seen so many more portfolios that have investor problems than investors that have portfolio. Portfolio
Yeah.
is definitely not the problem. So I
Right.
don't want to see your portfolio at the first meeting. I want to see what your behaviors are. So
Okay.
if you've ever, I'm sure you've heard this, you don't have to be a seasoned investor. The common statement on every investment offering, it
Mhm.
says past results are no indication or guarantee of future performance, right?
Right.
But what's interesting is past behaviors are almost always a guarantee of future behaviors. So we can
Oh,
identify them
yeah.
and we can cure them. Past
Yeah.
before, see, so we start by asking them discovery questions. So tell me about your history as an investor, to demonstrate some of the
Yeah.
most rational things you've done. And they may say, so I do this and I never sell anything. I bought what I have and I just leave it. And that's somewhat rational, but it's also not completely efficient because you need to do something, for example, called rebalancing. If you have a well-balanced portfolio and some components have run away and others have gotten on sale, you want to rebalance. So just leaving it and
Right.
setting it beginning it's not completely rational. It's not the most irrational thing you can do, but certainly not completely. The other thing,
Right.
this just happened recently. A person, no, I have that. The guy I'm working with, I think, does exactly what you do, but I do have a lot of cash. I said, well, is that cash there for any reason? Well, not really. It's just, but basically my investments though are similar to yours. So I said, "No, they're not, because I would never allow my clients to have cash turning their money into wallpaper, because as
Mhm.
inflation's growing at 3% a year, bonds freeze your money until the maturity of the bond. If I invest a
Right.
million in a bond today and it matures in 5 years, I still only have a million. I
Right.
need a million and 30, to buy for a
Right.
million bucks.
Right.
So
That's
what
true.
I explained to this person is there's only 4 reasons that people accumulate cash. I don't care what
Okay.
anyone says. I know one reason to me is the only legitimate one, and that is I'm accumulating cash like your client you described, who might have won a case. I'm accumulating this cash because I have to pay taxes. It's a
Yeah.
fixed and determinable reason that I've got this 200,000 set aside. Okay, that's reasonable.
Right.
Now, any other cash than that, the other 3 million,
Yeah.
it's there for one of three reasons. The fourth reason I just gave it. The other three are the illegitimate. So what happens is, the first reason is they have no plan. So if I have no plan and I make this cash, however I make it, the gravity that pulls it when I have no plan is right into my savings account. That's it.
Yeah.
I have no plan.
Yeah.
Second is I had a plan, but it failed me, so I've abandoned it. Same gravity pull, right to the savings account. The third one is more pronounced. So the third one is, in years of accumulating cash like this, there was a time when I took some of that cash and invested in something where the outcome was so painful that I have what's called regret aversion. And long-term regret is the most severe emotion because long-term regret never disappears. So it's the most powerful in terms of influencing us. And what it influences us to do is, in order to never face that regret again, we go to what's called status quo bias. I'm just going to leave it in cash. And then at least I know. Now, by leaving that in cash, the slow killer of money, inflation, will get you worse than anything else. And that regret you'll have, but you won't notice that you have it until it's too late.
Right.
15 years in, when you don't have enough money to buy what you used to buy, and start unwinding your principal to make up for the difference, right? Start selling the bond principal. So those are some of the things. So now that person told me they're rational and their investments look just like mine, but they don't. Maybe they're diversifying your stock piece, but that part of your investments is completely irrational. You're building all this cash and freezing your money into its biggest threat, which is inflation. Volatility is not a big threat. That's real. That's temporary. Market goes down, it recovers and goes to new highs. Inflation and the disappearance of purchasing power, that's permanent, never comes back. And so people conflate those two things. And the industry also causes investors to believe, because they misbelieve, that volatility fluctuations around the long-term average, that's the biggest thing. You should control the fluctuation of the number of dollars in your portfolio. And it's at the expense of killing the value of every one of the dollars, because you're putting more bonds in there to control fluctuation, which is the wrong problem. And so therefore the solution is wrong and actually works against the goal of money management, which is to build and accrete purchasing power.
Right. And I hadn't really thought about it because, I'm not so much into the finance side and the economy. But you're right. I mean, because I've always been taught, CDs, bonds, those, those are solid investments because
safe.
You're saving money. They're safe.
So think about it.
You'll get it back.
I just did a podcast today, my short version, Fix It Friday. And one of the ones I recorded was, investors think smooth is safe. And nothing could be farther from the truth.
Yeah.
The way we define safety, because of the way we've been mistaught, is in terms of principal fluctuation, volatility.
Yeah.
And when we misdefine it, again, we think we're being safe because it's not moving, but that slow killer is what we start now feeding with the bond purchase and the cash purchase. We start leading we put in our portfolio what I call the carrier of the disease of money, which is inflation. Bond. Right?
Yeah.
And so that's a huge problem for most investors, because the industry does generally have it all backwards.
Yeah. Yeah. Definitely interesting. Now I've got to go and check my stock portfolio and see what's going on.
Well, it's not just your stocks; it's your overall, right? It's look at the whole picture,
right?
And even things, like we're taught certain things, like when you think bonds are safe. So is what you've been told your whole life. Now, what I say to people is, if your risk is the disappearance of purchasing power permanently, then investments that lead to the protection and growth of purchasing power, those are safe. Stocks, investments in companies that grow dividends and earnings, those are safe. Investments that lead to the freezing and disappearance of purchasing power, those are bonds, that's risky. So what you've learned your whole life isn't, I'm not telling you something different, I'm telling you the opposite. So it's very difficult for a lot of people initially to embrace that, because it's counterintuitive and it's countercultural, but it's very real. And that's all involved with behavior. And for people, to succeed, I can teach people why they need to be more of an owner of great companies, stockholders, than a loaner to them, bondholders. I can teach them that. Stocks after inflation for 100 years have made 7% a year. Bonds have made 2.5 times more after inflation. why in the world would any rational person choose to buy bonds, right? You're going to run
Right.
out of money at some point. So we can teach them that. But the hard part of what we do and the why we're in behavior is they'll understand the rationality of doing that, of establishing that program,
Okay.
but they won't be able to stay with it and adhere to it through the pandemics, the tariffs, the recessions, and the bear markets and the Bidens and the Trump without our
Right.
counseling and help
Yeah.
continuously.
Yeah. No, I agree. I mean, I know when I first, when I got out of public accounting and I was like, "Oh, green light, I can invest in the stock market." I read, a handful of books and then came down, had my little spreadsheet and put together some, I can't remember now what the name of the theory was of whatever I was following and 20 years ago. And, I just remember like, okay, I can't set it and forget it. I've got to be active. I've got to manage this, but I can't manage. I'm not a day trader. I can't do this every day, which is
Right.
where like your firm comes in because, I would imagine, you're keeping track of things
Well, what's
and
interesting is so trading in terms, see, this is another human bias. So we have what's
okay.
called an action bias. The best way I can describe it to you non-financially is two ways. One is if you ever see someone continually pressing the elevator button, thinking it'll come faster, right? That's the action bias causing that. And the other
Guilty.
thing that's really that disturbs me is when you have that person who drives on the highway who's weaving in and out of the lanes to try and get
Oh,
there
not me.
faster, not
Yeah.
understanding that the average lane speed is the same thing. They get there at the same time unless they cause themselves to fail to get there because of their erratic driving causes them to get into a bad accident.
Right.
And so the action bias causes us to do things that are not rational. In investing, it causes us to think if we trade more, we're doing something. If I hire someone to manage my funds and they're not trading a lot, what am I paying them for?
Right.
Less is more when it comes to investing. When Warren Buffett was asked by Jeff Bezos, who founded Amazon, Warren, how'd you make all this money, never really creating a real business, but just being an investor? And he
Yeah.
said, you know how, Jeff? He said, because everyone wants to get rich fast. The best way and the only way I've known to get rich is slowly. Nobody wants to get rich slowly. So the key is not in finding the supercharged investment return of the day, because nobody knows what that's going to be. The key is in finding the best average return that I can sustain for the longest period. That's compounding. If I
Okay.
make 10% on my dollar this year, it's $1.10. I make 10% on that next year, it's $1.11. And that compound is like a miracle.
Right.
Einstein said it's the eighth wonder of the world. So
Yeah.
it's just so powerful, but it takes patience and discipline. And most people don't have either of those things on their own
It's tough.
consistently, right?
Right.
And
Consistently.
that's what we do. What we do is
Okay.
not, we use 8 index funds on the stock side to give our clients exposure to the most important parts of the global economy.
Okay.
Small companies, large companies, international, US, all that. There's no magic to that. We use index fund. The magic is in getting them to stay with it.
Right.
That when they look at it 10 years later and say, wow, I can't believe how much money I have. There was no magic. There were no
Yeah.
miracles there. It was all about discipline and allowing compounding to work. Warren Buffett's partner, Charlie Munger, who passed away a year ago, he said the key, the first rule of compounding is to never interrupt it unnecessarily. And every
Yeah.
time we do too much trading or we sell something for the wrong reason, that's exactly what we're doing.
No,
Interrupting compounding.
Yeah. So of all of our behavior, how much of it is learned instead of what is like we're just wired to act a certain way? Do you think
So,
I mean
so I think most of our behavior is a result of how we were programmed to survive
yeah.
physical threats 50,000 or more years ago. I mean, way in the African savannah,
Yeah.
we would, the lion comes out and the lion goes back. So what we do is our brain seeks patterns. Now I kind of know when the lion goes out. Now I know what time it is roughly. Right? Now I know when I can go and hunt. That's we seek patterns. It helps keeps us alive. But our
Right.
brains never developed to do anything but protect us from physical life and death threats. When today's threats are financial and not life and death. So at the base of our brain, we have these 2 organs called the amygdala. They're walnut-shaped like organ, and it's what really I call our fear sensors. And
Okay.
so when we were in the African savannah, you have lion and you run, before you even think about it. That's
Yeah.
our emotional intelligence. Takes care. You don't have to think. Well, the problem is today the amygdala can't tell the difference between the bear in the woods coming to kill us permanently or the bear market, that's a temporary decline. The amygdala shoots off, get out of the way, sell, ask questions
Right.
later. So our mind never developed to have us deal with modern times. So most of our behaviors are a result of those biases that are built into us to protect us against things that we don't have to be protected against today. And those same biases, unfortunately, put us in front of the danger of poor financial decision making, right?
Right.
And accelerate it. So that's so I'd say what's learned are some of the other things we talked about. So the learned things are stocks are risky, bonds are safe,
Yeah.
right? I want smoothness. That's a priority. That's what I should be. My priority in investing is I should have this instead of this.
Yeah.
Those are the things that are learned and need to be unlearned. But most of the reactions and responses we have, regret, fear, greed, envy, that's as a result of how we're pre-wired. What's called our wetware, our computer in our brain, the human computer. Our wetware was not created to help us survive the vagaries of the capital markets. It was there to help us survive the African savannah, life and death threats.
Yeah, that's a lot. Yeah. I can see all this. I mean, because I'm thinking through my life, just my history, and I'm like, yeah, I can absolutely see this is all how this is happening. So this podcast is geared to law firm owners, and most attorneys are just used to being in control, but making very fast decisions. And do you see that shows up in investing, that being in control and making fast decisions? Is that something that you
absolutely.
see?
There's something that's called the illusion of control. It's kind of like I don't know if you've ever played craps.
Yep.
Right. So the person who comes up, he says, let me roll the dice. Thinking that if they roll, or if they throw it harder, a certain number will come out. And if there was a soft, it's the illusion of control. If they have their hand in it, somehow it's got to come out better than if they didn't. And that's a very dangerous attitude. That's part of overconfidence. And those people would be best counseled to sit down with someone with our skills, right?
Right.
And hear it out, right? Because I'm honest about it. Like I wrote an article in the middle of 2020 that Barron's published, highlighting the habits of a group called Tiger 21. It's the wealthiest investment group in the country. A lot of them are billionaires. Yet it's $30,000 a year to join the club. And they published every quarter what their group was doing with their investments. In other words, broadly, in this quarter, we're increasing cash from 12% to 15%. We're increasing private equity from this to that, or decrease. And what I was able to prove from their own publications, and that's why Barron's published it, is these very wealthy people who are very knowledgeable in their fields of business are so overconfident that they make the same mistakes, as I mentioned earlier, as everyone else makes, but with two big differences: a lot more confidence and a lot more money. And it was consistent. So it proved to me what I already knew, that behavior is immutable, right? Human nature is immutable. It affects them the same way it affects everybody. Didn't matter how smart or successful they are. And again, because of their success, they become what's called epistemic trespassers. What that means is when someone's very knowledgeable in a certain area, and then they opine in an area they have no knowledge of, thinking that their knowledge in the first area makes them qualified to do so. And people think, well, this guy's so successful, better listen to him. So there's this natural association we have in this country between wealth and wisdom. And the only association I've seen consistently, and I don't mean this in a pejorative way, is I used to say there's no association, but now I've figured there's a correlation. It's negative. The wealthier people are, the worse they invest in terms of smart when it comes to investing. It doesn't apply because it's the emotional smart that's bad, not the intellectual.
So I come to you, I give you my assets, and I'm like, here, let's come up with a plan. But then, 3 months from now, I'm freaking out. What are you going to tell me to calm me down, to be like, look, we have a plan. The plan's working.
So
like,
what I'll tell you is what we talk about. So there's a process called onboarding, which is the initial kind of meeting before the client hires you. One of the things I do during the onboard meeting is what I do the lifeboat drill long before the bow of the boat's touching the water.
Oh, yeah.
If I've got to calm you down and I hadn't done the lifeboat drill, I'm going to fail. If you're already touching the water and I'm now coming to try and you're going to jump into the water. So it has to be done right at onboarding. I've got to challenge you at onboarding for a couple of things. So I teach them every year since 1980, if you're going to be a successful investor in companies through stock ownership, you have to understand a couple of things. Every year since 1980, the average annual slide down doesn't mean it stays down. is
Mhm.
15%. 15 for
Okay.
any or no reason.
Okay.
And then once every year, 5 or 6 years, the average, what's called bear market, which means down at least 20% from a recent high. But the
Okay.
average one is down 33. So I tell them, you have to be willing to stoically look at your portfolio of stocks, appear to disappear to the tune of 15% each and every year, and
Yeah.
to the tune of about a third 1 year and 5 or 6, and sometimes half. That's happened
Oh,
3
gee.
times in my lifetime. Half,
Right.
73, 4, 2000 to '02, and then '08 and '09 during the credit crisis, down 60%. If you can't do that, you're not suited to be an equity investor. Warren Buffett's partner said, and you deserve the mediocre results that you'll get. All right. But the truth is, they have to hear that coming in.
Yeah.
And when you explain to them that's normal, it's not that when the markets are down 30%, your plan is not working. And when we were up 20% last year, it is working. It's that the 33% every 5 years and the 15%, that's all part of the plan. We plan for that. That's
Right.
nothing unexpected. And so you
Right.
have to educate them at the beginning. The other way I try to help people at the beginning, because when you see the declines and you get nervous, it's natural. I don't tell them to suppress their feelings. Just don't reflect the feelings by altering your portfolio in a way that hurts what you put in there to make sure your long-term goals have a high rate of being achieved, high probability
Right.
of being achieved. And
Right.
so we tell them, so when it gets really bad, and it will, it's enough, it's going to get bad, meaning the declines happen. They'll recover, but they'll happen, and you feel uncomfortable. If you
Yeah.
feel real uncomfortable, I tell them, just don't think of the stock market. Understand that you own, in the S&P 500 as an example, some
Yeah.
of the best companies in America and the world. So take a ride during those periods where you're really nervous to the mall. Go into Starbucks and grab a coffee. Go
Okay.
into the Apple store. Take a look at all their new products. And then go to Nike and get a pair of sneakers. And then go home and see how many packages are waiting for you from Amazon. And then reassure yourself and say, you know what, just because the prices of these companies are temporarily down, their long-term enduring values are not going anywhere. People are
Right.
still stopping. I'm still getting order from Amazon, going to buy my Starbucks, right? So these are things we use every day, even during the 30% declines.
Yeah.
And so there's a lot of other people. So that helps you when you separate the stock market, which is, I call, one of the craziest places where some of the craziest people go to react to some of the craziest things going on every day. That
Yeah.
is not what you own. That's just a playground. You own great companies. What goes on every day in the stock market or in the short term is irrelevant to you. What's
Yeah.
relevant to you is these great companies are run by CEOs whose fiduciary responsibility is to maximize your value as a shareholder. So when
Yeah.
there's problems, they respond to them rationally. They'll lay off workers, they'll pay down debt, and
Right.
then they'll buy lesser competitive companies at pennies on the dollar during crises, and then they emerge
Absolutely.
stronger. And it's only earnings growth that matters. The other stuff, the pandemics, the recessions, the politics, all noise. The signal is the earnings. And as long as the population grows and you have a broadly diversified set of great companies like that, you're good. And when I tell people is I say, well, what if there's a nuclear Armageddon, whatever apocalypse yes, right? So I say
Right.
to them, listen, I don't discount the possibility of anything
Right.
like that. That anything is possible. But what I can tell you is that we don't do apocalypse here. If you want to marry a successful investment plan to anything, it cannot be married to an apocalyptic speculation.
Yeah.
And so what I tell them is, furthermore, if you're invested in bonds with all your money, and the next day the world blows up, your dollar's worthless, whether it's in bonds or stocks. And so what I've seen
Great.
is people who invest to marry their investments in gold and cash and bonds, things that
Yeah.
can't solve their real problem if the world doesn't end. And I
Yeah.
always say, there was a famous guy, Art Cassidy, who said, the ending of the world only happens once in a lifetime. It's a very long shot bet to bet on anything that happens once in a lifetime. So, but the point is, if they do that and they put all their eggs in that apocalypse basket, they
Yeah.
always so far ended up in a world that hadn't ended, but they created their own financial apocalypse because their investments never prepared them for the world that wouldn't end.
Yeah.
Okay. So that's the answer to that, right? But barring that, this all works for anyone who's going to follow it the best way in terms of
Right.
increasing the probability of success.
No, I love all that. Well, Jonathan, I've had you for a long time now, and so I don't want to type your whole day. What is the best way for people who are listening and they're like, "Oh my gosh, I need to get hold of Jonathan." What's the best way for people to get in touch with you?
So the best way is they should talk to you. So they can reach us on our website,
Okay.
fusionfamilywealth.com. All of our information and contact, all
Okay.
that is there, as well
Okay.
as access to our podcast called Crazy Wealthy and Thick Friday. Um,
Perfect.
and that's really the best way. So we, our minimums are $5 million, so we don't serve
Okay.
everybody.
Right.
We can't, otherwise it's easy,
Yeah.
you get too many clients. Uh, but um, but that's really the gist of how they can reach us.
Okay, great. No, and we'll make sure that in the show notes, we'll have the link so people can just click. They don't have to rewind
Okay,
and what was
great.
that again? Let me put the
All
link in.
right.
No,
Well,
but
this
thank you
was
so
fun.
much, Jonathan.
Yeah.
I've had so much fun talking to you. I'm now going to go sit in a corner and cry because of all the mistakes I've made.
No, no. Look, we all make mistakes. The thing that we have to do is learn from it, right? So we don't.
Right.
I always tell my kids the worst thing you can do is not make a mistake. It's to keep
That's
making the
true.
same mistake and correct the
Yep.
mistake with another mistake.
Yes. I'm all on board with that philosophy
Right?
for sure. I
Yeah.
tell my kids the same thing.
Yeah, exactly.
So,
That's all. I mean, we all make
oh,
mistakes.
right. Well, thank
I'd
you very
lie to
much.
you if I told you I've never made an investment mistake.
Well, and trust me, I've made my own in other areas, so I'm right there with you. You can't learn if you don't make mistakes. I mean,
That's
that's been
right.
my toughest challenge as a parent is, my kid's walking and I'm like, "Oh, they're gonna stumble," but I can't continue to tell them. They have to learn so that
Right.
otherwise they're never gonna avoid.
Say they
I mean,
have to
that's been
learn
my toughest
exactly.
challenge.
We kind of
Yeah.
let them fly on their own.
As hard as it is, because my oldest goes to college in the fall and I'm terrified, but
Yeah.
trying to be calm. So, but Jonathan, thank you so much for your time today. I've had a really wonderful conversation and I think our listeners will get a lot out of this. So thank you so
No.
much.
All right. You got it. Thanks for having us, Kelley. Appreciate it.
Thank you. If you are listening to this podcast episode and you're thinking, I know I need to understand my numbers in my law firm better, but I'm just not ready for CFO support. That's exactly why I created a program called Profit Strong 90. Now, Profit Strong 90 is a structured 90-day course designed specifically for law firm owners who want financial clarity without the overwhelm. So inside this course, you're going to learn how to understand your profit and loss without feeling intimidated, identify where profit is leaking from your firm, improve cash flow predictability, build financial habits that support long-term growth, and make better decisions using real data instead of gut instincts. Now, this isn't theory. It is practical step-by-step guidance built around how law firms actually operate. If you want to feel more confident looking at your numbers, if you want to stop guessing, and if you want to build a stronger financial foundation for your law firm, I can't make this any better of an offer. It's free. Click the link in the show notes below to join Profit Strong 90. This is where clarity starts for you.